Hi everyone, I'm Dhara Ranasinghe, EMEA Markets Editor for Reuters, and I'm your moderator for this very exciting panel on emerging market debt issuance and investment. It's a great pleasure to have on stage Treasurer Sharon Almanza from the Philippine Bureau of Treasury. Sharon has held positions in the Ministry of Finance and brings depth of experience in debt management. Next to her is Nick Smallwood, Portfolio Manager and EM Financials Strategist at M&G Investments. Nick has worked for some of the world's biggest asset managers and financial firms on both sides of the Atlantic. Oyebanji Fehintola is the head of Treasury and Financial Institutions at the Africa Finance Corporation, a pan-African multilateral development institution which has 43 members. And Philippe Waechter, Chief Economist at French asset manager Ostrum Asset Management, which is part of the Natixis Group that manages 400 billion euros of funds. Philippe is an avid watcher of all things global economy. So we've got a lot to get through over the next 40 minutes. I will try my best to get to questions at the end, so please do send them through on the app. But let's get started. So there was a lot of enthusiasm for emerging markets at the start of the year, based around what we thought would be a Fed pivot late last year. It was going so well. Debt issuance was at a record $50 billion at the start of in January, and that's hard currency debt issuance. That has slowed to $7 billion in April, slowing for 3 months running. And April and May are meant to be busy months for debt issuance. So what's going on? Clearly, the outlook is murkier. US interest rates are staying higher for longer. The dollar is strong, and geopolitical risk is high. Sharon, let's turn to you first, because the Philippines is one of the most active issuers in Asia. You've recently issued a $2 billion bond sale. What does this changing backdrop mean for you?
All right, thank you, Dhara, for the question. As a debt manager, as you see, it's not only funding the government in terms of your usual financing requirement. We also have to take into consideration the risk when we do this exercise, especially on the funding. So what we did initially is to, prioritize local currency in our funding strategy for the year. But then again, we recognize that not everything can be financed locally. That's why we have a considerable amount of program in terms of our global issuance for the year. So we have a program of $5 billion and as you mentioned, we just issued this month our the $2 billion ROP that we call. So it's 2 tranches. So one is on the 10 and the other one is on the 25-year. Initially, when we were doing this exercise, since we prioritize our domestic funding early part of the year, we're able to mobilize a substantial amount. That's why we were monitoring the market. We were one of those that initially noted that the Fed would be cutting rates early part of the year, but unfortunately we didn't have that crystal ball like all of you. So now that the U.S. Treasury has somehow, as you mentioned, the higher for longer narrative, we took advantage of when the U.S. Treasury stabilized early part of this month. So we're able to do a transaction, as mentioned, the 10-year and the 25. The peak order book was more than 8 times oversubscribed during the peak, and because of that, we're able to compress our the spreads that we had. So from initial price guidance, we're able to compress it to 40 and 45 basis points for both tenors, and this also allowed us to issue these 2 bonds in a negative new issue premium. So we're able to have a negative 5 and 7 basis points. You see, as an issuer, every basis point matter, right, when you're trying to reduce your debt service. And this landmark transaction allowed, it's one of I think in the region, since 2021, it's the tightest spread on a 10-year note, and for the 25-year, it's the 3rd tightest spreads that we had on a 25-year. So it's a matter of really monitoring the market and make sure that you have all the regulatory approvals so that when that timing is there for you to execute, then you take advantage of that.
So timing is key. Banji, what's the perspective from Africa?
Yeah, I mean, we haven't issued a bond in 2 years, and I think that's largely because of a couple of factors, which some you mentioned. You know, rates have been high, and I think market conditions weren't so great at some point. But I think for us, it's really not that much about base rates being high. You know, base rate being high affects everyone, you know, but it was more around how credit spreads were skewed against emerging market borrowers, particularly African borrowers. So, you know, post-pandemic, you know, and since the Fed started tightening rates, we saw, you know, credit spreads move significantly wider. And we didn't like that. So we generally don't like the credit spread. And if I'm speaking for myself as an issuer who has been active in the bond market, you know, we're producing record financials, strong fundamentals, but the credit market, the bond market particularly, hasn't recognized that in terms of a tighter spread. So, you know, that whole notion that African issuers have to pay significantly wider premium has been the major reason why we've stayed away. And when we discuss this internally, we always say we don't want to validate the prejudice, essentially, because we think it's a prejudice premium that we're paying. Because, I mean, we have an A3 rating. We look at similar rated entities in the GCC or elsewhere issuing at 150, you know, basis points cheaper on spread, you know, so that's a bit wide. So that's really, you know, if we're looking at ourselves as an issuer, that's the reason why we've stayed out, you know. And again, we've seen our spread coming over time. We're spending a lot of time doing investor engagement, educating people. So I think that has helped. So hopefully, and I obviously know that we won't stay out forever. At some point, we're going to come back in. So I think that has helped significantly. But broadly speaking, if I just look at the African continent, you know, at the beginning of the year, there are a couple of issuances. We saw Cote d'Ivoire, I think we saw Benin, we saw Kenya. African Development Bank came as well as Badia. And since then, supply has dried up. So I think it's really that whole notion that rates may come down. And if rates do come down, people want to pick the right time to come back into the market. So I hope we're right. And if it's higher for longer, then at some point, we all have no choice than to accept the new normal.
And just sticking with you for a moment, the truth is that a lot of bond issuance for EMs have to be paid back. I think over 50 billion this year, more so in 25 and 26. Do you see any pressure points?
Not really. I think maturities will come. People will finance, they will refinance those things. I was looking through the data. I know Nigeria has an upcoming maturity. I don't know if it's this year or next year, but hey, it's 500 million. Nigeria has just had a positive outlook from the rating agencies and all that. So re-engaging the market shouldn't be a problem. I think Gabon, Angola also have upcoming maturities. Those are all oil-dependent economies. Oil is holding up above $80. So I think they will be fine. The fact that there's a bit of very limited supply also helps because, I mean, if I'm thinking as an asset manager, I also want to diversify my portfolio. I'm looking at Africa as a place where I can diversify, participate in the growth story, and at the same time get a yield pickup, and the issuers are not coming. So eventually when they do come, I suspect that we will see significant uptake in those bonds. There was an issuance, I believe, yesterday, you know, by corporates, which, you know, virtually everybody was swimming. The book was like 3 times oversubscribed, an African issuer. So I think the lack of supply is positive because at some point what that means is it forces investors to think twice. I mean, even speaking for ourselves, a lot of investors have approached us bilaterally for us to do private placements, knowing fully well that, yes, we don't like what we see in the public market, and they also do admit that the public market isn't pricing the credit properly, and so they come for bilateral private placements and all that. So I think refinancing will not be a problem. reforms are going on the continent, and I'm pretty positive that all the refinancing will be done, easily.
Thank you. And Nick, Banji made a good point. Some positives in emerging markets, some ratings upgrades, some emerging markets have front-run rate cuts already. So give us the investor perspective.
I agree. I think you made a lot of very good points. And speaking, with my investor's hat on, I don't think that there are tremendous pinch points, as you described them, to come up across emerging markets, really, absent a few idiosyncratic cases. I mean, broadly, whether you're talking about sovereigns or corporates, which is more my world, I'm a non-sovereign expert, fundamentals are pretty strong. In the corporate world, if you look at investment-grade corporates in EM, for example, leverage is about 1x, which is record lows and much lower than investment-grade developed market leverage would be in the corporate world. And the same for high yield. It's about 2.5x in EM. It's about 3.5x, I believe, in the US, something like 4.5x in Europe. So fundamentals are pretty good. And the main thing that's holding back more investment in, or maybe more investment appetite for, and possibly issuance from the more high yield issuers is this higher for longer. Because if you look at the spread compression you've seen, I mean, Banji's been talking about Africa, let's talk about Nigerian corporates and banks. They were 6 months ago trading at spreads of 1,000 plus. They're now broadly 500 or a little inside 500, which means if rates come down below 5%, they're able to issue below 10%, which is really the threshold of sensible issuing levels. So we are waiting for these rate cuts to come through. And so you have the spread compression driven by the optimism that was going to happen in late last year, very early this year, which has now dissipated a bit. You also have a tremendous technical impetus, which Banji alluded to. I mean, again, if I can just throw some corporate numbers out there, worldwide, global EM, you're expecting about $190 billion of negative net issuance this year, which is mainly Asia. It's about $150 billion versus Asia, a lot driven by China and the implosion of China property and so forth. So although the asset class has been in modest outflow, it's more than compensated for this lack of issuance. And I honestly think as soon as the rate cuts come through, the taps get turned up quite dramatically. You see tremendous appetite for emerging market risk from crossover investors, particularly in investment grade and highly rated high yield primary deals. It tails down dramatically once you get down to some single B territory. And that's where I think we need the rate cuts to come through.
So that leads us into the next question pretty well, is there is a debate in emerging markets about tourist money coming into emerging markets, non-traditional investors, most of that cash going into higher rated names, such as Mexico. Where do we start to see the trickle down? Where do we see more of that money going into the broader EM asset class? Philippe, what's your view?
What is interesting in the current situation is that we have a global economy that is changing. When I heard you, you said, well, what is called now the Grand South is leading the economy. We don't expect too much from the US, too much from Europe, but a lot from Asia, a lot from Africa. And that's what is interesting at this moment specifically. And so in that environment, people are willing to take more risk on issue. You spoke about your issuance. And that's really a change from what we knew in the past. Probably the oldest on the panel. And, for a long, long time, you didn't want to go on emerging market when there was scary things in the US or in Europe. The first thing you closed was your investment to the south. This is no longer the case, and that's why it's interesting. And with what's happening in the US, with the fact that the Fed is delaying its rate cut, we say, well, we have other opportunities, and probably the economy will develop differently elsewhere than in Europe or in. So in that environment, it will be interesting to to look closely at emerging countries. But I have a question for you, because you spoke about Africa, and you know, things have changed in Senegal recently, and there is a discussion on what is called the franc CFA. You know, there is a currency zone in Western Africa, and in Senegal, they said, well, maybe we could exit from this zone, and in that case, probably the zone will no longer live. So what could be the impact on this situation for issuer in Western Africa? Maybe you don't have the answer, but I have the opportunity to ask you the question.
So I consider myself lucky that not only answering questions from the moderator, I'm also answering questions from the panelists. And, I mean, to be honest, the noise is there, and that noise is not new. You know, in Francophone West Africa, that noise comes all the time. Some of that has to do with, you know, colonial legacies, which I suspect, you know, people feel they just want to put behind them. But, you know, if we're just looking at it realistically, the economies of Francophone West Africa have been broadly stable, largely because of the currency arrangement that they have with the French Treasury and the peg of the ZOF, you know, that has helped them to have significant amount of stability. And what do I mean by that? You just need to look around the continent and see how currency fluctuation, you know, has really almost murdered many economies. Nigeria being an example, where the currency has moved, God knows, 200% or something like that. Egypt had a similar run on their currency, but that has not been the case in Francophone West Africa. So I kind of feel, you know, if you put the political noise aside and we're thinking just economics, I don't think our view as an institution, and I think even many people on the street, the view isn't that the peg is about to be abandoned or about to break. We're not taking that bet. We think it's going to stay because the benefits somewhat outweigh, you know, the costs to them. So our view is that that peg is not under threat, at least in the short term. On that, I hope I answered that.
So, Philippe, I'm coming back to you because I don't think we can have a conversation about emerging markets without talking about China. Sentiment towards China has been pretty poor, but the government there has been doing a number of measures, latest announced last week, to shore up the housing market. With the context of the broader EM universe, what's going on with China's economy mean for emerging markets more generally?
Well, that's an important issue. With what's happening with the discussion with the U.S. and the trade barrier, trade tariff, etc. So my guess is that we won't go back to the kind of cooperative, coordinated world we had before the pandemic. And so everyone needs to be more autonomous in its way of doing. So you have the US, and the US said, well, we want to do without China on electric vehicles, on batteries, etc. We will do it. We can have a real question on that. Europeans do not know exactly what they will do. And China said, well, we will do. And so that's, and the impact on Africa, on Asia, will still be very important. So what is interesting at this moment is that you spoke about the residential market in China. It's no longer the source of impulse in China. So what is important to keep in mind is that Xi want to reinforce the strength of the manufacturing sector. It's already the strongest in the world. You know, it's more than 35% of all manufacturing products in the world. US is 12, Eurozone is 13, so it's a strong one, and they want to continue. And the point here is that all the Asian, African, and even Latin American countries will need these opportunities with China. And in that case, we will have a world that will not be so homogeneous as we had. And that will be, for the economists, it's a wonderful period. For the world, it's probably more difficult because we don't want to work with the other as we did in the past. And that's a real question. We have tension everywhere. We've seen that this morning again in Taiwan with the Chinese boats around Taiwan. We have a lot of risk now, and the perception we can have is that developed countries are probably not the first being able to regulate this, and that's new, and that's the world in which we have to live in the foreseeable future, and that will be interesting. And in that case, as I mentioned before, probably Grand South will have a stronger future than in 10 years or 20 years ago.
So let's stick with risk. I mean, you're talking there a lot about geopolitical risk, but we've also got election risk, South Africa elections next week. Nick, as an investor, what does emerging market election risk mean for you? Do you see through it?
Well, I mean, broadly, yes. To be honest, South Africa is one interesting one where things could get quite volatile. But I mean, broadly, in terms of geopolitics and elections, there's a lot of both of those around. Election-wise, we're not seeing big changes outside the South Africa one. So you had the Indonesia election where Prabowo has broadly continued economically as before, not roiled markets. The other big one coming up is Mexico in 2 weeks' time, where Claudia Sheinbaum is the favorite to succeed AMLO, and she's very much the successor candidate and will broadly continue as well. So there have been a lot of elections, but they've not been ones that dramatically changed the outlook, certainly for the worse. The big one that changed for the better was Turkey last year. Erdogan's election led to the restoration of orthodox macroeconomic policy, which has enabled them to issue debt, has encouraged FDI, has improved, or starting to improve the inflation situation, and has certainly improved the market perceptions of Turkey. So in terms of EM election risk, I don't think it's anything the market can't take in its stride. In terms of the geopolitics, it's a similar story because you've got a lot of geopolitics out there. Right? You've got obviously ongoing US-China tensions. You've got war in Russia, Ukraine. You've got Israel, Gaza. You've had, it's not geopolitics, but the big market moving one was, of course, the Chinese property sector implosion. Those are all known factors now. The market has moved past them. We've talked about very tight spreads in general. And so I don't think that either geopolitics or elections are necessarily going to negatively affect emerging markets. The one big election that is the curveball, of course, is the potential return of Trump in the US. And there, he hasn't really articulated a policy platform, so not sure what happens if he gets elected. But again, does it really change much with regards to emerging markets? Because regardless of whether Biden or Trump is in, they're going to be pretty hawkish on China, to say the least. They seem to be competing on that one. The other big market, in terms of emerging markets that gets affected by US policy a lot, is Mexico. But economically, they've been benefiting a lot from nearshoring, to the extent that the usual pre-election economic slowdown due to uncertainty of outcomes that you get 6 to 9 months before an election hasn't happened this year because of the boost of factories being built, particularly in the north of the country, as American companies move their factories from China and other parts of Asia back to Mexico. Does that really change? Not sure. So So I'm not sure that Trump is as big a problem for EM, really, as he could be for developed markets, vis-a-vis the EU, vis-a-vis NATO. Of course, Ukraine, but that's not really a pan-EM issue. So I think in terms of the geopolitics and the elections, while there is a lot around, I don't think it's necessarily something that emerging market investors need to be too worried about, and I'd be much more focused on US rates, US inflation. And just as a sidetrack on that, the interesting thing there is that while the inflation shock in the rest of the world, EM included, was very much commodities driven and price shocks of food and energy from the Ukraine war, the US inflation is driven much more by domestic factors, tight labor market, etc., which means it's likely to be stickier for longer. And that, again, actually leads to opportunities for emerging markets on the local side because they're much more advanced in the rates cutting cycle than their Western counterparts, which is why local currency assets have done so well in the last 6 to 9 months.
So let's talk about local currency bonds and turn to you, Sharon, because Philippines is a big issue of local currency debt, and the trend there just generally has been picking up. What's your view on the outlook for local currency issuance?
Well, I think as an issuer and as a debt manager, as I mentioned, the goal really is, your ability to source your financing, if you can do it locally, without really issuing offshore, because with that you're able to manage a big risk, which is foreign exchange risk, and you're also supporting development of your local capital market. Most emerging markets, we have a very, well, if not shallow, it's not that deep, unlike, of course, the US dollar market, the Eurobond market. But as much as possible, we also want to be dependent on our local currency. So that's why it's very important that as a government, as an issuer, we also support the development of the capital market. So in the Philippines, we try to rely heavily on local currency in terms of our funding. So we have this financing mix, which is, we have a 75-25. So most of our funding is on local currency, but it's one thing that we really want to, to improve moving forward. It's one of the points also being raised by our credit rating, that we still have a substantial amount of external debt. That's why we want to further increase our funding, in terms of funding for local currency. But as mentioned, there are several challenges, such as you still need to develop your primary market, your secondary market, now the repo market as well, so that you have a working domestic capital market. But definitely as an issuer, it should be one of your priorities, so that from time to time you still want to tap the international capital market, right? Because you want to diversify your investor base. But you can also diversify your investor base in the local currency market. But that's one thing that the Philippines is also working to achieve. Right now, we have a very small participation of foreign investors in the local currency market. So it's unlike our peers in the region, wherein they're able to attract more foreign investors. We only have, I think, less than 3%, in terms of participation in the domestic bond market. And that's why we are working with our counterparts in the central bank, also with the Securities Commission of the Philippines, and also with JP Morgan, because we want to be included in the JP Morgan bond index. Right now, we're still not part of the JP Morgan index for domestic currency. And that's one thing that we are trying to also work with, so that we can attract more foreign investors. We know that there are several challenges and issues that we need to also address, so that we can attract, or at least tap those big investor base that are also investing in domestic currency.
So what are the main challenges?
Well, one of the issues that they raise is the liquidity. As mentioned, our domestic bond market is not very liquid. Sometimes there's absence of two-way quotes, so not some securities don't have quotes, and it's very wide when when the quotes are available. So that's one thing that we're also working with our market makers. Another issue that they raise is the tax. So we have one of the highest withholding tax in the region. So we're, we have a 20% withholding tax, but we're also working with our Bureau of Internal Revenue right now, to be able to implement the tax treaty. Because while we have, a high withholding tax, we have tax treaty in place with other jurisdictions, right? So if you're an investor and you reside in that country with tax treaty, then you're supposed to be taking advantage of that treaty. But it's kind of difficult to have that. So right now we're working with the Bureau of Internal Revenue so that there will be a streamlined process and it will be easier for an investor to take advantage of that treaty. And there's also a bill pending in our Congress that will potentially reduce the withholding tax, but it's going to be a long process since it will take legislation to have that approved.
So Banji, let's bring you in on the challenges. You talked earlier about this prejudice premium. What are the big challenges that the African emerging markets need to face or tackle to draw in more investors?
Well, I mean, to be honest, I think some factors are within our control, some are not. What is within your control is trying to be a responsible issuer, running a solid business with good fundamentals, etc. Or as a country, if you're a country issuer, trying to have sound economic policies, debt sustainability, friendly policies that promotes, free markets, hopefully, and all that stuff. So all those are within the control of the company or policymakers. And more importantly is communicating that as well to the rest of the world. Because I think if I had to apportion a blame to many African issuers, and maybe to some extent emerging market issuers generally, is that lack of adequate communication. So engaging with investors, letting them understand the story. You do your best to change perception as much as you can, but that's how much you can do. The factors that are not within your control are more, factors around how people just view the continent. The media is not within your control. There's almost nothing you can do. You can put as much good news out there, but if more bad news is dominating, sadly, that's what it is. The rating agencies, I saw them around earlier on, so I'm being careful what to say, but they also contribute to the problem in my view. This whole notion of, everybody's bad. If we downgrade one person, we have to downgrade all of you. I spent a large part of the last few years educating rating agencies on why investments we make in projects are far better rated than the countries in which we've made those investments, simply because of structuring. I mean, you make an investment into a project, all dollarized, all the cash flow is offshore, not a cent of that comes in country. And the rating agencies say, yeah, we see that, but we have a model. Our model says once the country rating is this, everything must be below that. It's just a lot of education. People need to understand that risk management isn't just one way. There are several ways you can skin a cat. And I think that's really where we have a bit of an issue between the way the rating agencies look at rating and the reality on ground. Until we bridge that gap, it's going to be costly. I was listening to the president of the African Development Bank speak maybe last week or recently, and he actually was saying, look, you say Africa has a debt sustainability problem, but a large chunk of that is from the premium that they pay. And he was quantifying it. He says the premium is costing Africa $70 billion in premium that Africans have to pay. And then we now go back and say, let's renegotiate the debt later. So I think it's really a collective. What we can do, we will continue to do. But I definitely urge everyone sitting here and everyone looking at the continent, you need to have a different mindset when looking at the credit. There's so many good credits there, and they shouldn't be paying the kind of premium that they pay.
Thank you. I see we're coming up to the 5-minute marker, so I'll just check if we do have some questions. I do have a question, and we've got time. So we talked about US interest rates and that staying higher for longer. But the reality in emerging markets is there's also a debate about the scope for rate cuts being limited as US rate cuts are priced out further into the future. Nick, do you think that the clock is ticking for emerging markets to stay on the front end of rate cuts?
Yeah, up to a point, yeah, because they've already done a lot. And the problem you have is if the differential grows between lower emerging market rates and a higher Fed rate, then that's eventually going to have an effect on the currency, which obviously affects your debt payment ability as well. So there's a balance between the two. If the US rate cuts do come through in the second half of this year, then they can continue. But they've already done quite a lot. So even if they have to pause and wait, it's not necessarily a bad thing. I think that's how I look at it.
So, I mean, for us, yes, we've stayed out for some time. And I did mention earlier on that we can't stay out forever, because I know that the flip side of that decision is that your investors are no longer engaged. You know, your secondary curve is no longer trading because there's no new issue coming out. So it's a delicate balance between waiting for rate cuts and coming back to ensure that you re-engage your investor base. So I think for us, the way we're looking at it is even if rates will be higher for longer, then maybe potentially, even if we're coming back to the market, we could be coming back with, you know, maybe rather than just doing a plain vanilla senior bond as we've always done, could we potentially look at hybrids that we know that, yes, we're paying up, but we are getting equity recognition, which helps us to grow the business and, you know, support our capital ratios, et cetera. So that's the kind of trade-off that we are thinking about. And again, we're not going to stay out forever, irrespective of what the Fed does.
Nick?
Just one follow-up. I just wanted to say as well, I think this is where you get a big, in the scenario you've described, a big differentiator between those markets with developed local capital markets and those without. Because those who are having to issue internationally are really waiting for the Fed. But those where the rates have come down locally, and there are, you know, the larger, more developed local markets, you know, the South Africas, the Brazils, the Mexicos, a lot of domestic issuers there are choosing to issue domestically anyway because the swap costs are high. So why not just issue locally if you can? Rates aren't crippling. And that, of course, then adds to the positive technical of less dollar debt around. So if you look at South Africa, for example, they've got a really strong banking sector, which used to have, you know, 10, 12 bonds outstanding. We're down to 1 because they've all refinanced locally. So that's a source of liquidity for those companies in those countries. And it helps, on the technical side, shrink the investment pool even further, really, which gives you, again, a real impetus to your asset prices of those bonds that are in existence and do continue.
Great. So to sum up, Philippe, maybe we could start with you and work back this way. As we head into the second half of the year, what would you say is the biggest positive and kind of risk, if you like, for emerging markets?
Well, for me, the main risk is to expect too much from rate cuts, because there are a lot of opportunities. And so waiting for rate cuts that will not come is not something is something we have to manage. And so that's the point. Do it now, do it because it will create added value in your economy. And it's not a problem of financial business, I would say. And that's really the situation that has changed in many emerging countries. There is opportunities for business that didn't exist 20 years ago, that exists now, and we don't have to wait until the Fed, until the ECB or someone else do something, because it will be too late. And I think that many emerging countries now have the opportunity to act by themselves. And that's quite new. And, but I would say that the main risk, not now, not in 6 months, in 1 year, is what will happen when the world will converge to the energetic transition. I think it will be a big change for everyone, and that's why everyone on emerging countries has to do things now, because at this moment it will be much more complicated than now. And so the opportunity is to do things now, to create value now, not later.
Thanks, Philippe. Banji, last point.
Yeah, so what I heard him say is hope is not a strategy. So we're not just going to sit hoping that Fed will cut the rates, we'll do something now. But that said, what I would just close with is to say emerging market issuers are looking at all sorts of markets now. I mean, we worked on a transaction with the government of Egypt where we provided a wrap, a re-guarantee, and enabled them to tap the samurai bond market. And when we did that transaction, you know, Egypt saved about 800 basis points off their dollar curve, just going to Japan with a wrap provided by investment grade, you know, guarantors like ourselves. Those types of opportunities, you will see more and more of them. The higher rates stay, people become more savvy, and they are looking for opportunities in different pockets across the world. So I think we'll see more of those going forward.
Nick, is there a point you'd like to end on?
I think just to sum up, it's just that I think for emerging market investors, emerging markets are in a pretty good place. You have value on the table still from particularly high yield sovereigns. Fundamentals are pretty strong. And it's hard to see, it's famous last words always, but it's hard to see, other than Trump doing whatever he may do if he gets elected next year, it's hard to see in the next 18 months or so a bump in the road which derails the strong story of recovery and inflation, superior growth to developed markets, ongoing interest rate differentials in the correct direction. So I think, frankly, for all the the worries, people always focus on the geopolitics and elections and so forth. But actually, the economic picture for a lot of emerging market countries and the fundamental outlook for a lot of the corporates is actually pretty strong. And it's an asset class that we support.
Sharon, last point with you.
Oh yeah. I was just trying to reflect on what Nick mentioned, because we still have a sizable requirement, and we're one of those that we were really looking forward to a rate cut, but given what's happening, and even in the domestic market. We are also hoping that our central bank will be moving soon, but given the performance of the peso as well, maybe it will not be wise if our central bank will move ahead of the Fed because the peso has been depreciating as well. But as you mentioned, we have to take into consideration the cost of our debt service. So with that, I think it's just a matter of really engaging with our investors, so that when the time comes that we decide to issue again, given our sizable requirement, we will have that support that we always have, whether it's going to be in the next half or in next month or so. It's, as you mentioned, it's all about timing, and executing properly. Because as Nick mentioned, what we have is a good credit story. Fundamental is right. The macroeconomic story of the Philippines has been great in the past, and the government has been continuing the reforms that the past administration has been, has put in place. So it's a matter of engaging with the investors to ensure that when the time comes that you issue, they will always support you. Thank you.
Great. On that point, thank you so much for your time, and let's say thanks to our panel. Thank you.
Thank you.